Good morning, everyone. My name is Jason Collins, and I'm with URL Insurance Group. I'm an agent support specialist here at URL, specializing in single premium life with living benefit solutions for your clients. First off, I'd like to thank everyone for taking the time out of your busy schedule to be with us today. Those of you that are currently doing business with URL, I'd like to personally thank you. We understand that you have many options as to where to place your business. That's why we appreciate you working with URL, and we'll promise to continue our dedication to your success. Some of you are new to the URL family. Welcome. URL is a full-service national broker. We provide agents complete support in all of our lines. URL provides single premium life, fixed and indexed annuities, traditional life products, as well as individual and group health products. We also have a senior division that offers Med Sup and Med Advantage products. So please take a moment after the webinar to tour our website at www.urlinsgroup.com and discover if there are any additional avenues for URL to assist with your success. So again, that website is www.urlinsgroup.com. Now, I'm extremely excited to be part of presenting this great program for you today. Single premium life has been growing in popularity the past few years. People, and more specifically baby boomers, are realizing that they have cash value in old whole life policies that they don't need to continue to pay into. They have money that is set aside and earmarked for the next generation, making little or no money in CDs and savings accounts, and have real concerns about their future with long-term care needs. Now, today we're going to discuss a few new ideas that will help your clients with all of these concerns. I'm proud to introduce Jason Goodrich. Jason is the Senior Wholesale Manager at Equitrust Life. He's here to review the recently unretired single premium life options that Equitrust offers, the WealthMax Bonus and WealthHorizon single premium life, and how they could benefit your clients. Before I turn it over to Jason, I'd like to mention, should you have any questions during the broadcast, there is a question box on the right side of your screen that you can type them in, and we'll certainly answer them at the end of the program. So without further ado, I'd like to turn the program over to Jason.
Thank you very much, Jason. Let me bear with me, folks, here.
The other one, Jason.
Yeah, I apologize here. Hang on a second here. Well, we might have a problem here. How are we there, Jason? Still same?
I think you got it. If you flip back a couple slides. Yep, there you go.
We good? All right, thank you. I apologize, everybody. I got a new computer system here, so still getting used to our new screens. Good morning. As Jason said, my name is Jason Goodrich. I'm a National Account Manager with Equitrust Life Insurance Company. First off, I'd just like to thank everyone for taking time away from your busy schedules to join me this morning for an overview of the relaunch of two of the most successful single premium life products in the industry over the last almost 10 years now. Both the WealthMax and WealthHorizon were reintroduced in just the last couple of months. We've also seen a significant ramp up in sales already. I think you'll see why these products have been so popular as we go through this presentation this morning. And I don't want to take up too much of your time, so I'm going to try to keep this presentation to hopefully around 20 or 25 minutes or so, and just cover the product and the positioning of the products at a fairly high level. However, as we go through the presentation, as Jason said, just type in any questions you may have, and I'd be happy to address those at the end. Lastly, let me thank Jason, Joe, Maria, all the great folks over at URL Financial Group. URL has been a top marketing organization with Equitrust since the very beginning, 15, 16 years ago, for both life and annuity. Really appreciate their support and long-term partnership. With that, let's go ahead and get started. First off, when you look at single premium life with Equitrust, really there's kind of two main positionings of the products. The first, and what we see, I guess the majority of, would be as a wealth transfer vehicle. So those folks that have a lump sum of money sitting somewhere that they don't think they're going to need down the road in the future. So a quick example of that would be a 60-year-old that has $100,000. If they were to reposition that money into single premium life insurance, it would immediately change the value of that to $195,000 tax-free death benefit. So obviously, if their goal is wealth transfer, it's going to make a lot of sense. But the other area where we're seeing a lot of business, and I'd say probably close to 40% of the sales now, is for those folks that maybe don't have adequate coverage to address a chronic illness need down the road or a nursing home need down the road. This can be a great alternative for that as well. We'll get into that deeper here in a little bit, but the same example, that $100,000 is going to give that 60-year-old client $194,750, presumably tax-free, to help pay for home health care down the road or nursing care down the road. So it's a great way to address that need without buying a traditional long-term care policy. So really, those are the kind of the two positionings we see of the product as a way to address wealth transfer, or as a way to address a chronic illness or nursing home need down the road. And one thing I'd like to talk about at the beginning too is kind of the source of funds. So where we see the money coming from. For example, on the annuity side, about 70% of our business is replacement business on the annuity side. So what I mean by that is 70% of the business is coming from either another annuity or a life insurance policy. That is not the case with single premium life insurance. With us, well over 80% of the business is not replacement business. I think we're talking about maybe about 15% replacement business. The majority of what we get is coming from, as Jason mentioned, like CDs, savings accounts, money market accounts, typically liquid money or CDs or something like that is where we typically see them repositioning to single premium life insurance. However, we do see cases where somebody has an old annuity. Maybe they've had it there for a while that they just don't need the money for, and they're willing to pay the tax on the gain on the policy and send it over to us. That totally makes sense. And we also, and Jason brought this up about old whole life policies, we also see a fair amount of business where somebody has a life insurance policy that for one reason or another isn't performing, that they can 1035 exchange over into a single premium policy. A good example of this is something I just dealt with actually 2 weeks ago with one of my groups. Is they have a bunch of agents that have sold old Transamerica whole life policies many years ago. And these policies haven't performed. So these clients are still pumping in $60, $70, $80 a month into these policies to keep them going. They don't have a ton of cash value, but what they're doing is they're taking that $20,000 or $15,000 of cash value, and they're 1035 and exchanging it over to our single premium life product. And by doing that, they're getting a paid up policy that they no longer have to pay premium into, plus they're getting the ancillary benefits that single premium life insurance now offers, like the chronic illness benefits we discussed. So it can definitely make sense for old life insurance policies as well. Okay, before I get in and talk about the products a little bit, let's talk about a couple of things that apply to both of the products that we're going to talk about today. Number one is the underwriting process. It is a very simplified underwriting process. It's a point of sale process. What that means is during the point of sale, when you meet with the client and do the application, you will get a decision on the phone right then and there in most cases. So if it is a decline, you'll be able to pivot to something else at that point. It is accept, reject, right? Standard to table 4. So if it's table 4 or better, it's accepted. If it's lower than table 4, it's declined. Okay. Now the only thing from an underwriting perspective that are going to involve the client is some health questions on the application and a point of sale interview. Now the first thing you'll want to do is you'll want to pre-qualify the client. And we have in our agent guide, we have a list of the questions. We also have a one-pager that just lists the health questions. And the key to the health questions is the client needs to answer no to everything. So if you pre-qualify them and go through those questions and they answer yes to something, then they're not going to qualify for this, so do not proceed with the application. If they answer no to everything, however, they should qualify, and at that point you can proceed with completing the application. Then once you're done with that, you would do the point of sale phone interview. Okay, you as the producer would initiate that phone call. You would hand the phone to your client, and they would just re-ask the health questions on the application. In no situations are we doing exams or fluid draws, okay? The only thing involving the client, once again, is the completion of the health questions on the application and the point of sale interview. Now, during the interview, the interviewer will look at prescription history. We'll look at MIB just to confirm that nothing contradicts with how they answer the question. If it does, they will circle back at the end of the interview and ask about that to try to figure out, what the misunderstanding is between the two. Okay, so for any cases that are $250,000, that are under $250,000, you will get the decision right there at the end of the phone interview. The average interview is about 15 minutes. A client would hand the phone back to you. The interviewer would give you the approval over the phone, and then you would just need to send in the application. Okay, we do not do APSs, medical records, if it's under $250,000. Now, if it's $250,000 or above, it's the same process. The only difference is we're going to order an APS. We'll pay for it. We'll order it just to confirm everything. Okay, and then we'll make the approval. So below 250, no APSs. 250 and above, APSs in every case. And then we do real-time notifications too. Obviously, you're going to get a notification right on the phone, but we also send out an email, and also through our mobile app, we notify you of the approval. Okay, so that's the underwriting process. It's the same for both of the products we're going to talk about today. The other thing that applies to both products we're going to talk about today and is the same is the living benefit rider or the accelerated death benefit rider. Okay, as I mentioned a little bit ago, about 40% of our sales, this rider is the main driver of the sale from the research we've done. As you know, lots of people don't want to buy traditional long-term care insurance anymore because of the use it or lose it nature or because of the cost of it. This is not, the rider we're talking about today is an accelerated death benefit rider. It is not a long-term care rider, so I want to make that clear, but it does and can address some of the same needs. Okay, now with the Equitrust living benefit rider, it is automatically included in the policy at no charge in the states where it's approved. Okay, so there's no cost, it's just automatically added to it. Now, if they ever use the rider, so if they ever take the money out with the rider, then there is a one-time charge of just $250. Okay, now with our accelerated death benefit rider, there are 3 triggers. Okay, the first is terminal illness. So if they have less than 12 months to live, what we would do is we would just take 95% of the death benefit. We would pay that out to the client in a lump sum, tax-free, okay, for terminal illness. The second trigger is nursing care confinement. So to qualify for this, they would need a stay of 90 consecutive days in a nursing care facility. If they meet that requirement, they can take the money out in one of 2 ways. The first way is they could just do a lump sum and just take out 85% of their death benefit. Okay. The problem with that is they do that, they're going to lose out on 15%, obviously, and the policy would be terminated at that point. Okay, but they do have the option to do that. The other option, and what most people elect, is they elect to take 100% of the death benefit over a 3-year period. Okay, so it's a very easy calculation. It's just whatever the death benefit is at that time, minus the $250 charge divided by 36 months. That is what their monthly payment will be each and every month for 3 years to pay for nursing care confinement. If they pass away 2 years into that, the remaining amount is just paid in a lump sum to their beneficiary. Okay, so they're always going to get all the money out that way. And the third trigger, and really the one that's probably the most popular, you hear most about, is what we call chronic care, also referred to as chronic illness. With this, you do not need to be confined to a nursing care facility. So to qualify for this, it's just the loss of 2 of 6 activities of daily living for 90 days and expected to be permanent. Okay, so it needs to be expected to be permanent, but they do not need to be confined. So like home health care would qualify for this. So if they meet that requirement, once again, they have the option to do a lump sum. This time it would be 75% of the death benefit, or once again, they could do what most people do and take a monthly and get the 100% of the death benefit. With chronic, the 100% of the death benefit is paid out over 5 years. So just take the death benefit divided by 60 months. That's what they would get each month to pay for that. Okay, this is an indemnity plan. Okay, so you don't have to submit receipts or anything like that to us. We just need to know that they're chronically ill, get that letter from a doctor, and we'll start paying monthly checks to the owner. Okay. Okay, let's get into the products now. Once again, that rider and that underwriting process we just talked about apply to both of the products. Okay, the first product I'm going to talk about is the WealthMax Bonus. This was a leading product, single premium, simplified issue product in the industry for 5 or 6 years. We did pull it about 1.5 years ago, but as Jason mentioned, we are relaunching it here just recently. So you may have heard of this product. Okay, first off, so just some of the standard features with it. The issue ages are 45 to 80. Our average issue age on this product is about 68. Okay, that's kind of the average client. Average premium is about 80 or so thousand on it. The minimum premium is 10,000. The maximum premium is based off face amount. So 750,000 face amount. So how much max we can take is dependent on how old the client is. As I mentioned, this is a guarantee product. So it has a guaranteed death benefit, right? So if you put $50,000 in this, you'll have a guaranteed death benefit that they're guaranteed to get. It will not lapse unless they're taking out loans or something like that, then it could, okay? And has a 10-year declining surrender charge. Now, some of the things that kind of separate this product from the industry is, number one, it does have a premium bonus up front. So you get an immediate 5% bump on the premium, which also gives you a little bit of a bump on the death benefit immediately. One of the great features about this is it does have a return of premium guarantee day one. Okay, so basically what that means is just what it says. If for some reason they need to surrender this money, they're guaranteed to always get their premium back. Now, if they've taken out a withdrawal previously, it would obviously be their premium minus that withdrawal. But one way or another, they're going to get all their money back if they need to. That's one of the reasons this product works so well for the liquid money that I talked about earlier. Now, we don't want people buying this knowing that they're just going to surrender it or treating it like a liquid account. That's not how it should be treated. But what the return of premium does is it gives the client peace of mind, addresses that concern. What if my emergency fund's not enough? What if a catastrophe happens and I need to get at it? This gives them the peace of mind to know, you know what, I can get at it if I need to. Also, it does have withdrawals on top of that. So it has a return of premium, but if they just need to get a little bit of money out, they can take out 5% per year. Okay, so it has some other liquidity options in addition to the return of premium. And then lastly, it has lots of different crediting options. It's an index product. I'll show you the caps and rates in a second. But in addition to the S&P 500, it also has a brand new custom index through Barclays, exclusive to Equitrust. It also has a vol control in the S&P that other carriers use on annuities. So it has lots of different allocation options to hopefully maximize the growth potential within the product. Now, it is life insurance, so I do want to point out quickly there are charges associated with it. Okay, there's going to be a cost of insurance, there's going to be a monthly policy fee, and there's going to be a policy expense charge that'll be deducted monthly for 15 years. Now, the important thing to remember about this is any of these charges you see on the screen, they will never reduce the death benefit below the guaranteed death benefit. They will also never reduce the cash value below the return of premium. Okay, so the charges, so if they put $100,000 in this, it doesn't matter what the charges are, their guaranteed cash value will always be $100,000 or more. Okay, so it'll never reduce the values below those. Okay, here's the strategies and the rates. And then on the right here, you'll see what the illustrated rate is. So if you run an illustration, what it will illustrate at. So we just have a fixed account. We have an S&P point-to-point cap. We have a monthly average on the S&P with a par rate of 85. And then we have the two indexes I talked about briefly a little bit ago, a point-to-point par account through Barclays, that I'll talk about in a second, and then a point-to-point par account through an S&P vol strategy. And you notice those rates are really high. So on the Barclays, it's 110% participation rate and no cap. On the S&P vol, it's 120% participation and no cap. So a lot of nice growth potential there. The illustrated rate on the right you see is 4.57 because we're required for the max illustrated rate to be based off the point-to-point S&P cap. So even though if you did a look back on the Barclays, it's going to look a lot better than 4.57 a year, we can't illustrate it that because it doesn't meet the regulation that we're required to meet. Okay, briefly, let me talk about the Barclays strategy. It's called the Barclays Focus 50. It is exclusive to Equitrust, so it is only on these two products. It's not even on our annuities or anything at this point, just on the two single premium life products. Obviously, the goal is to get the highest return we can while maintaining a volatility level. This is a very simple custom index. As you probably know, there's some pretty complicated ones out there, but we've chosen to go the route of very simple. So what this strategy does is it's just going to look at the 50 lowest volatility stocks in the U.S. So on a given month, it's going to look at every month, whatever the 50 lowest vol stocks are is what it's going to use. And what you'll see when you look at these 50 stocks is they're very well-known companies, okay? They're the very long-term, stable companies like Coca-Cola, Johnson & Johnson, Walmart, Procter & Gamble, Waste Management. So big, stable companies that all your clients are going to be familiar with, okay? So it just uses those 50 stocks in combination with 4 different links to treasuries, okay, of bonds, 2, 5, 10, and 30-year bonds, a mixture of those, right? And then lastly, it will use cash if it needs to maintain the volatility of 5%. Okay, I'm not going to get a lot into this. I'm happy to discuss it, later or whatever people like to talk about it. But it's a very simple strategy that's performed very well. Year to date, it's up over 11%. And keep in mind, the participation rate is actually 110%, not 100. So it'd be up even more than that. Okay. The other vol control index we have is not exclusive to Equitrust. There are some other carriers that do have this on their annuities, and it's also performed very well. And once again, very simple as far as volatility control indexes go. It's going to use 3 components that everybody's going to be familiar with. Number 1, it's going to use the S&P 500. Number 2, it's going to use gold. And the reason it uses gold is gold's a great hedge against inflation. So it's going to use gold. And then it's going to use the 10-year treasury. So those are the 3 components it's going to use: S&P 500, gold, and U.S. Treasury. And it's going to mix the money up in a way to maintain that 5% volatility control. Okay, this one's actually up over 11.5% year to date. And if you look back over the last year, it's up over 14%. And once again, this one has a 120% participation rate. So actually would perform better than those numbers I just gave you because of the par rate. Okay. So those are 2 new strategies we've added to our single premium life that was not on them previously. Okay, commission. Obviously, we're going to pay you a commission on it too. So, and this is a change we made as well too. We're going to pay the upfront commission like we did before, which is 8% up to age 75, and then reduces to 7.5 from 76 to 80. However, we added a couple trail options. These are long-term contracts or life insurance, so we're underwriting. So hopefully they're going to live for a while. So trails make a lot of sense on these products. So we have an option B, which is half upfront and a 75 trail. So 4% upfront commission, then you get 0.75 on each anniversary as a trail. Then the option C, which we're actually getting a lot of business in, is really strong. It's just a 1.25% trail commission. Okay, so you get 1.25% immediately, then on each anniversary, 1.25% of whatever the account value is. Okay, so any of those 3 options are available for you to select when you do the application and submit your commission form. Okay, so when you look at the WealthMax, I think it really does 3 key things for your client. Number 1, it's going to give them that tax-free and guaranteed death benefit. If they want to pass money on to their kids, their grandkids, church, charity, what have you. Number 2, with the living benefits, it's going to address that need that a lot of clients have not addressed, which is the ability to have tax-free money to pay for nursing care or home health care down the road. And number 3, it's going to give them the peace of mind to know, if something happens, I can get my money back. And that's what that return of premium feature does, is it gives them the ability to change their mind down the road if they need to. Okay, let me walk through a case example here, then I'll talk about the other product. That's a very common scenario we see here at Equitrust for the business into the WealthMax. We got Carolyn, she's age 60, she has $100,000 in a CD earning 2%, so doing pretty well in the CD. Her objective is just to pass the money on to her 2 grandkids when she passes on, and she does have the concern for health-related expenses during her lifetime. What we're going to do here is we're going to give Carolyn 3 options. We're going to look at how it would perform if she leaves the money in the CD and continues to earn that 2% rate, which is a strong rate. We're going to give the option to move it into a fixed annuity at a 3% rate, or obviously the third option is to purchase the WealthMax bonus. So we're going to take this chart, and the first thing I'm going to pull up here is the CD. Now, keep in mind, the CD is going to be taxable, right? It's not tax deferred, and we're using a 24% tax bracket for this example. So that $100,000, obviously, if she leaves in the CD, immediately is going to be a $100,000 death benefit. In 10 years, $116,000. In 20 years, $136,000 and change death benefit when you factor in the taxes. Now let's look at the annuity. Obviously, the annuity is going to be tax deferred. However, at death, in most cases, it's going to be taxable to them. So immediately $100,000 in 10 years, it's going to be $126,000 to the beneficiaries, and in 20 years, $161,000 to the beneficiaries. Now, thirdly, we'll look at the WealthMax bonus. So with the WealthMax bonus for a 60-year-old female, $100,000 is going to give her a guaranteed death benefit of $195,000, not only immediately, but 10, 20, 30, 40 years down the road, worst case scenario, $195,000 tax-free death benefit. And keep in mind too, this is an index product. It doesn't show on here, but that death benefit could be higher than $195,000 based off the index performance. So what I'm showing you is just a low bar here with the 195. And just to put a little perspective to this, if that client were to stay in that CD at the 2%, it would take them 41 years to equal the $195,000 immediate death benefit of the WealthMax. So 41 years to do that. With the annuity at 3% and tax deferred, it would still take 27 years for that annuity to equal $195,000, right? So I think when you put some perspective to the client like that, and we're actually working on a supplement down the road where you'll be able to use this to show your client that it's going to take a long time to get what you're getting immediately if your goal really is wealth transfer. Okay. Now let's take the same example. Let's just assume she needs to access the funds to pay for terminal nursing care or chronic illness. Okay, the terminal illness is going to guarantee her a lump sum of $185,000 to pay for that. If she needs to go to a nursing home, it's going to guarantee her $54.09 a month for 36 months to pay for nursing care confinement. For home health care, it's going to guarantee her $32.45 a month for 60 months to pay for chronic illness. And these numbers you see, these monthly numbers, are going to show right on the illustration. Okay, you're going to be able to see those numbers. Your client's going to be able to see those numbers. Okay, and once again, if she were to pass away before all that was paid out, the remainder is just paid in a lump sum to the client. Okay, what I'm going to show you now is, I'm not going to show you the illustration, but we have a couple supplements we in the last year or so have added to our illustrations, which we've gotten really good feedback on. That I think do a really good job showing your client the value of the single premium life insurance. They're part of the illustration, but they look more like a marketing piece. And you can see one of them on your screen right here. And at the top, you can see it's called the Power of Guarantees. This is really showing your client all the guarantees they're going to get by purchasing the WealthMax bonus. Okay. If you look at this, you'll see guarantee written all over this page. I believe it says it 9 times on here. Okay, so on the left there, you see it's going to show their guarantee return of premium, right? It shows worst case scenario, you have $100,000 in here. The $100,000 you put in is always going to be in here, worst case, for you to take out. The middle there shows your monthly chronic illness, your monthly nursing care, and your terminal illness lump sum benefits, right? Once again, those are guaranteed numbers because they're based off the guaranteed death benefit. And then over on the right, it shows that guaranteed death benefit of $195. So just a nice one-pager that really sums everything up for what the client is getting by purchasing this product based on their inputs, their age, their premium, their underwriting class, et cetera. Okay. Now I'm going to switch to another one here that looks about the same. Okay. This is another supplement. It does not automatically print with the illustration, but it's one that you or URL can elect for you to be included in the illustration. And it looks like the Power of Guarantees one I just showed you, except at the top you'll notice it says Life Expectancy Snapshot. Okay, what this is going to do is instead of looking at the guaranteed numbers, it's going to look at the non-guaranteed numbers at their life expectancy age. Now for a 60-year-old female, her life expectancy is 88. So you can see there in the green, it says life expectancy age 88. Okay, and it's going to show the same things. It's going to show the cash value, the living benefits, and the death benefit, but it's going to do it based off the non-guaranteed illustrated numbers. So instead of $100,000 cash value, you can see the cash surrender value is $185,000. You can see, for example, the nursing care is $65.80. On the previous slide, for the guarantee, it was $54.10. The chronic's $39.48. On the previous slide, it was $32.46, so an additional $700 a month, right, to pay for chronic. The terminal, as you recall, was 185,000 lump sum, but based on the non-guarantee is 225, right? So you have one, and then the death benefit instead of 195 is 237. Okay, so you have one supplement that shows worst case, and then you have another supplement that shows illustrated numbers. So really good feedback on these as a point of sale piece with the client kind of summing up the product and the illustration. So I did want to point that out. Okay, that's the WealthMax bonus. We'll talk about the other product, the WealthHorizon, which is very similar. I'm going to go through this a little quicker, but it's a very similar product, but a couple key differences. First off, issue ages, once again, 45 to 80. Premium requirements are the same. It's also a guaranteed death benefit, right? So it's not going to lapse. 10-year declining surrender charge schedule. What differentiates this product, though, is a couple things. Number one, it does not have return of premium guarantee, okay? So there is no guarantee to get your premium back on this one. Number two, there is no premium bonus, okay? So the WealthMax had a 5% premium bonus and they return a premium guarantee. The WealthHorizon does not have either of those, but what it does have in exchange is it has higher face amounts. So higher death benefit and has a lot higher caps and rates, so a lot higher growth potential. Okay, so for the client, what it comes down to is what's more important, really, the return of premium or having a higher death benefit and higher growth potential, right? Most things with the product are the same other than that. It does, once again, have the strategies, the S&P 500, the Barclays we talked about, and the S&P vol control. And although it doesn't have return of premium, it does have liquidity. It has a 5% penalty-free withdrawal each year. It has the ability to take out a loan if needed. Okay, so there are some liquidity options within it, and it also has the same accelerated death benefit that the WealthMax had too. Once again, there's charges on it. Really, the only difference with these charges is there's no return of premium, obviously, and it's a 10-year policy expense charge instead of a 15-year charge. Where the client's really going to see the differences here with the rates. Okay, you can see it's a 5% fixed account. The point-to-point cap on this is 11. On the WealthMax, it was 7%. So you have a 4% higher cap on this product than you do the WealthMax, which obviously is huge. The Barclays is at 150. It was 110 on the WealthMax. The S&P Mark V was at 120 on the WealthMax. It was 165% participation rate, right? If you remember those numbers I gave you earlier, you know, on the actual performance was what, 11.5% year to date. Multiply that by 150% or 165%. You can see there's some really big growth potential within the WealthHorizon product because of that. Okay. Commission, we do pay a little more on this one. So instead of 8 like it was on the WealthMax, it's 9 on the WealthHorizon. Because you don't have the return of premium, it's probably going to be a little more difficult to sell. So we do pay a little more commission on it. Also has the option B, which is half up front and then trail, and the 1.25 trail, which actually is the same as on WealthMax. Okay, let me just talk about a couple more things and we'll open up for questions. I do want to mention taxation because that comes up a lot. First off, these policies in most situations are MECs, are modified endowment contracts. That's not a bad thing though. Some people think because it's a MEC, it's going to be taxable, but no, the death benefit's still not going to be taxable. Okay, even if it's a MEC. By being a MEC, is all it means is withdrawals and loans are going to be taxed like an annuity would be taxed. Okay, so if they're going to take distributions from it, they're going to be taxed like an annuity. And to be honest, if their goal is distributions, this product's not going to make sense for them. Okay, to take like income distributions from. Then another thing I want to mention is the accelerated death benefit rider. Okay. If it's accelerated because of terminal illness, it's going to be income tax free. If it's because of nursing care or chronic care, it should be as long as it's taken and used properly. It meets the same limitations and guidelines as long-term care payouts. Okay, so we're going to report it as on a 1099 LTC form when we pay it out. It will be up to the client to make sure they use those funds to pay for that need, for that home health care need, right, or that nursing home need. You know, if they use it to go out and buy a new car, they can do that, but if they do that, it's probably going to be subject to taxation, right? And it's going to need to meet like the per diem and stuff too. So you just want to be careful to make sure they're taking it the same way to make sure it's not taxable. So definitely consult a tax advisor on that. I want to point this out. This is what we call a show book. What it is basically is an old school flip chart, right? like kind of the old school just flip chart where you flip through it. It's a really good piece we've had for a long time to walk through the value of single premium life with your clients. It talks more generally about single premium life than it does about the products, but explains to them helps them understand the value of using single premium life. We have these in many different formats. We have them in PDF and PowerPoint on our website, but we have a really nice printed version of it that you are able to order if you're appointed with us, or you can contact Jason and he can order and get out to you. But just a really nice piece. And it also goes through the same case, a very similar case scenario that I went through on the WealthMax, where I compared the CD, the annuity, and the life. It does a similar example in this. Okay, just summing up, we have the two products, the WealthMax and the WealthHorizon. On the bottom of the screen there, you see what both offer, which is the same underwriting process. They both have a guaranteed death benefit. They both have the accelerated benefit for chronic and nursing. They have the new unique indices through the Barclays and the S&P Mark V we discussed, and the trail option, which can make a lot of sense for you. Basic difference between the WealthMax and the WealthHorizon is, with the WealthMax, you get a bonus and you get return of premium. With the WealthHorizon, in exchange for not having that, you get higher face amounts and higher caps, right? So that's what it comes down to for the client, basically. Just quickly here, I just want to show kind of the stats through the end of last year. On Equitrust, we're just under $19 billion in assets, very high investment grade portfolio, 97%. RBC ratio, which as you probably know is an important ratio on how much capital we hold, at 348%, and solvency just under 105. So very financially strong company. In fact, I don't know if any of you have heard of the Wards 50, but you can go to their website if you have not. Basically what they do is they go back and look at all health and life and health companies and review 5-year financial performance, okay? And based off that 5-year financial performance, they select the top 50 carriers. And Equitrust actually has been ranked in the top 50 for the last 4 years by Wards 50. So there's an independent group that does this on their own. And if you go look at it on their website, you'll notice they list all the carriers, and there's a lot of big names on there, big names that your clients are going to know. And Equitrust has made that list, that Wards 50 list, which is a pretty big accomplishment, we think. With that, I think I've taken enough of your time, so I'm going to close it here. And before I see if there's any questions, I just want to thank everybody for their time today. I hope you'll contact Jason, get appointed if you're not. Take a look at these products. I think there's definitely a need and definitely a fit with your clients. Jason?
Yeah, hey, thanks, Jason. Great, once again, great and informative presentation. I love these products. It does not, you did a good job, so it doesn't look like there's a lot of questions right now. So
okay.
With that, I want to thank everybody for joining the presentation today. Please feel free to call us at URL for all of your single premium life or annuity needs. If you want to talk some sales ideas, if you need company brochures, personalized illustrations, or, questions do arise after the fact, you get home, you're sitting on the couch and you think of something, give us a call. We'll absolutely answer it and answer any of those questions. So our toll-free number is going to be 1-800-926-8875. Again, my name is Jason Collins. I'm at extension 156. You can also ask for Joe Corio. He's at extension 111. Maria Adams, she's at extension 102. Or Cody Wilbert, he's at 136. So thanks again, everybody. Have a great day. Thanks a lot, Jason.
Yep, thanks, Jason.